Good morning and happy Tuesday to all you wonderful melon heads out there. Today is April 25th, 2003. And a big story this morning, we got 3M has just announced another 6,000 layoffs around the world. This is in addition to 2,500 layoffs that they had previously announced earlier this year. So 8,500 positions combined being laid off at 3M, who makes, well, just about everything. They make glue, they make parts for cell phones, post-it notes, tape. They're everywhere, right? Just a big industrial slowdown across the board. When a company like 3M is laying people off, you need to pay attention because 3M serves, well, the whole economy. So what does that say about the whole economy? Not very much. Elsewhere, last night, we got our first glimpse under the hood over at First Republic Bank, and it's worse than we thought, folks. First Republic Bank saw a loss of over $100 billion in deposits during the March bank run. Worse than we thought. Now, they're announcing a couple of different things. I'm hearing some are reporting a loss of $70 billion in deposits, some a loss of $100 billion in deposits. The difference being some are accounting for that $30 billion rescue plan that JP Morgan and the other big banks made to First Republic back in that first week. Some are not reporting that, but that's the big difference. If you hear $70 billion or if you hear $100 billion, the difference is that $30 billion loan that they got from the other banks. Net borrowings in the quarter peaked at $138 billion. That means First Republic was borrowing money from anybody and everybody they could, including $25.5 billion borrowed from federal home loan banks. Also, tens of billions borrowed from the Fed's discount window. That is expensive debt, which means First Republic is paying more in interest on that debt than they're earning on their loans, which means this bank is not going to be making money anytime soon. That's if they even survive. They're announcing a 20 to 25% headcount, so there's even more layoffs going on at First Republic. And of course, they are discussing their strategic options, which means this bank is probably looking to sell itself to a larger competitor, more consolidation in the banking system. And with that, we are going to shrink my big melon of a head, and let's see what's going on in markets today. We've got the S&P is down 16 points, about 0.4% at 4120. This morning, the Dow Jones Industrial Average is down 30 points, or 0.09% at 33,845. Could have been a lot worse. It was down much more than that pre-market. And the NASDAQ leading the way lower, down about a half of 1%, or 55 points at 11,982, below the all-important 12,000 level. Looking at the strength of the U.S. dollar, the DXY is surging a little bit this morning, up 28 basis points at 101.63. And over in the bond market, well, we've had some movement in the last few minutes. At one point this morning, the 1-month yield was down another 14 basis points. It seems to have recovered a lot of that right now, although still in negative territory at 3.52. That is the market still worrying about the debt ceiling, despite all the progress that was made yesterday on the debt ceiling. Just kidding. They didn't do anything yesterday. They made no progress on the debt ceiling. They have no plans of making any progress on the debt ceiling right up until the last minute when they think they're going to get everything done. And the problem is everybody is so convinced that they're just going to wait till the last minute and solve the problem at the last minute, or at least pass a bill to raise the debt ceiling at the last minute. The fact that everybody thinks that's what's going to happen, that tells me there is more of a danger that it doesn't go that way, that there's some kind of a political accident and this thing doesn't get done on time. Pay attention to that 1-month yield. Elsewhere, the 10-year yield is at 3.43, down about 7.5 basis points right now. And the 2-year is at 4.04, down 10 basis points. So a little bit of a flight to safety going on this morning on the long end of the curve. And check this one out. This is 1-year U.S. CDS spreads. This is the cost of insuring U.S. government debt. And do you see this spike? This is bigger than the 2011 debt ceiling. This is bigger than the GFC. The cost of insuring U.S. government debt against default is higher than it has been this century, folks. Pay attention. The bond market has this one right. The bond market is telling us this is not such a done deal, this debt ceiling. Pay attention to that. Elsewhere, looking over at commodities, we got a whole bunch of red across the board in the commodity space this morning. Gold is at $1,997, down $2, below that all-important 2,000 mark. And silver was getting pretty much price smashed this morning. It's currently at $25.19, only down about 32 cents, or about a percent and a quarter. It was down 77 cents at one point this morning, which had me saying, well, there's that options expiration price smash. And just take a look at the silver chart. We were way, way down this morning. Seems the buyers came in and bought it back up. We'll see where we close today. Again, options expiration. There's almost always a certain amount of shenanigans going on right now. They smash the price down just in time for the option to expire worthless, and then the following day they let the price rise again. I have no reason to suspect they'll do things any differently this month than they do every other month. This is the nature of precious metals investing. Looking else over, speaking of gold and silver, check this one out. Central banks are buying the most gold on record as they diversify their reserves. Almost 33% of all gold purchases in the last, I believe it was last year, was made by central banks. And check this out. Look at the net purchases, the spike that we saw at the end of last year in net purchases of gold by central banks. The central banks are printing money, stealing value from your savings, and using it to buy gold. What does that tell you? I'll let you draw your own conclusions from that one. But suffice it to say, gold market is getting tighter. Central banks can read the writing on the wall. I would add that is mostly Eastern central banks as we continue to buy nothing but IOUs here in the West. But here is the main story this morning. 3M cut 6,000 positions globally to improve cash flow. 3M said on Tuesday that it would cut 6,000 positions globally as the U.S. industrial conglomerate looks to focus on high-growth businesses, including automotive, electrification, and home improvement. They always say, oh, yeah, we're going to focus more on whatever industry is buzzy and fashionable at any given time. We're going to focus more on blockchain. We're going to focus more on electric vehicles or wind or solar. They always say something like that every time there's bad news. We're going to shift our strategic focus to something that tests very well in focus groups. That's always what comes out of their mouth. But the main draw here, 6,000 jobs being cut. And you got to scroll all the way down to the article, and they mention here the restructuring, which is expected to hit all functions, businesses, and geographies, is aimed at reducing layers of management and the size of the corporate center, the company said. Tuesday's job cut is in addition to the reduction of 2,500 roles announced earlier this year. So, again, that's 3M, folks. These guys make everything. Job cuts at 3M is a very bad sign for the economy. Elsewhere, take a look at what's going on in First Republic Bank this morning. The stock is now down 27.5% this morning. I believe that is a new 52-week low. We're just a nickel above the 52-week low right now. So First Republic, stock is basically as low right now as it was during the height of that bank run back in March. Why? Well, here we go. First Republic lost $100 billion in deposits in the banking panic. And it was actually 104 billion deposits. I'm sorry, 102 billion in deposits that they lost. The bank says it'll cut headcount by as much as 25%, slash executive pay as it restructures the balance sheet. Customers pulled about 100 billion in deposits out of First Republic Bank last month when a pair of bank failures shook America's faith in regional lenders. The bank's first quarter earnings report Monday detailed its precarious financial situation following the massive withdrawals. First Republic shares have lost nearly 90% of their value since early March. They fell around 20% in pre-market trading following the earnings report. Deposits fell more than 40% to $104 billion at the end of the first quarter from $176 billion on December 31st. The first quarter tally includes $30 billion from mega banks such as JP Morgan Chase, meant to keep First Republic afloat, suggesting last month's panic cost the bank around $100 billion in deposits. And I just want to scroll all the way down here. I want to make this note all the way towards the bottom of the article. The bank's balance sheet showed $166.1 billion of loans as of December 31st at amortized cost, basically the held to maturity value of those loans. A footnote said that the fair market value of those loans was $143.9 billion, which means if they leave those loans on their books and wait until they're fully paid back, they're worth $166.1 billion. But if the bank tries to sell those loans, say to raise cash needed to meet investor withdrawals, they'll only be able to get $143.9 billion. That's kind of like the assets for sale. This is an accounting gimmick that First Republic is using to make their loans look more valuable than they really are, than what they can turn around and sell it for. The $22.2 billion difference was greater than First Republic's $17.4 billion of total equity, or assets minus liabilities. This bank is insolvent, folks. There's no other way to put it. This bank is insolvent. The only reason they even look solvent on paper is because they're valuing all these loans not on what they can get for them, but if they were to hold them for the remaining 30 years, waiting for all that interest and all that payment to be made, that's how they're valuing the stuff on their books. This is an accounting gimmick that every bank in the country is doing right now, and it's making them look more solvent than they really are. Pay attention to this. This will come back to haunt them if they start taking losses in commercial real estate or if the withdrawals continue. Elsewhere in the market right now, UPS profit falls on lower e-commerce demand. United Parcel Service on Tuesday reported a fall in first quarter profit as the freight bellwether grappled with softening e-commerce demand due to economic uncertainties. The global shipping downturn has squeezed margins for most operators in the sector as the COVID-19 pandemic-driven e-commerce bubble deflates and shoppers wrestle with soaring inflation. It's another bad sign for the economy, folks. We've got 3M laying off workers. 3M makes stuff that is used by everyone. We've got UPS profit is lower because everyone is buying less stuff. The writing is on the wall. The economy is slowing. One other thing I want to mention is Bitcoin, folks. Take a look at this chart right now, down to about $27,300 this morning, sitting right around that 50-day moving average. Keep an eye on this one. Is Bitcoin going to get a bounce here? If we break down below, we're probably not looking at anything like support until we get into the mid-24,000s range, or even worse, the 200-day moving average, which is down around 21,000. Important thing to keep in mind with Bitcoin is liquidity, folks. For the first time in Bitcoin's history, we have a shrinking money supply. Bitcoin has never seen a shrinking money supply before, so we don't know how it's going to react to that. We've also got the situation going on with the regulators targeting all of the exchanges. That's going to sap liquidity from Bitcoin's markets. We've also got the prospect of asset deflation going on across. So Bitcoin has never been through a period like this. Just be careful, folks. And sitting at this 50-day moving average, that's an important technical level that I thought I would mention for everybody here. And I have a thank you that I have to send to, where are you in here? There we go. Thank you, Mr. Michael Schneider. I appreciate the super chat and the support of the channel. He says, question on government default. Why isn't partial government shutdown an option instead of default? Shutdowns used to be how that was handled. That is an option. Government shutdown is an option, and it will happen if there's a default on top of that. The reason why a shutdown is no longer enough is because the government has constantly maturing debt that has to be paid back. Okay, so what they normally do is they take out new debt to pay off the old debt. And that has always worked because interest rates have always dropped. Well, now, if they take out new debt to pay back the old debt, the borrowing is at a higher interest rate, which means they need to borrow even more money, but they're up against the debt limit. So they can't even borrow enough money to pay back the old debt, and therefore they default on the old debt. So even if they shut down the government this time around, that's still not enough. Because of the higher interest rates, they would still default on that debt. It's a good question, Michael, and thank you very much, sir, for the super chat and for the support of the channel. I appreciate that very much. Let me just make sure I didn't miss anybody. That was everyone. All right, guys, I just want to say thank you very much for your time. Thank you to my Patreon supporters. I appreciate everything you guys do for the channel. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.